chance to see the father of Ethernet. And so, without further ado, Bob.
Thank you. George said this is going to be a tough audience today, and that it would be a cold day in hell before I would meet your expectations. So when I woke up this morning, I said I might have a chance. So as George has said, I'm a venture capitalist. I've previously been a student. I was a student for 23 years, so for those of you who are students, I know what you're going through. And then there was the entrepreneur stage, out of which, the engineering science stage, out of which Ethernet came. Then there was the entrepreneur executive stage, out of which 3Com Corporation came. And then there was the publisher journalist, 10 years of writing really ugly columns that really upset people. And now I'm a venture capitalist. But all of those careers are all, in my mind, are all technological innovation careers, in one role or another, in getting technology developed and put into use. But now I'm a venture capitalist, and I've been at it for 3 years, and so I think the goal of this hour is for me to share some of what I've learned over the last 3 years, but to keep it close to what I know about longer term. I thought I would talk about the kinds of venture capital investments that are being made in networking, which has been my life's work. But just since we don't know each other that well, let me just read the 7 kinds of networking I'm going to talk about, and then see if you have any questions. I'm going to talk about enterprise Ethernet, backbone networking or Ethernet, access Ethernet. Does Ethernet come up a lot in my talks? Yeah. Access to the internet, the video internet, mobile networking, embedded networking, and RFIDs. So, does anyone have any questions?
Yes. Is it mostly as physical layers?
I'm a plumber, but I'm willing to wander above the physical layers if you want. Although I get quickly out of my area of expertise, if I have any expertise left at all at this late date. VCs don't write code, and they don't build hardware. And this is my 3rd year of a 7-year, what I think of as a 7-year apprenticeship as a VC. So I'm learning completely different stuff than is taught in the engineering school here. But if you want to talk physical layer, I'll see what I can do. Any other, please, questions? Yes.
RFID is a network. How do you see RFID as a network?
Well, we'll get to that, but isn't it obvious? There's readers and there's tags, and they talk to each other. And the tags can be unpowered, completely passive number things, but if you get into a class 4 tag, you can have a mesh of communicating microprocessors. So I view that as the very low end of networking. But that would be a semantic discussion as to, I count it as part of networking. Since I'm a networking expert, I want as much to be called as networking as possible. Some more questions. Help me zero in by asking some more questions.
Well, as a venture capitalist, how do you heat up before victims who come in front of you? Can you describe the inquisition process?
Well, we try not to have it feel that way. I guess it was true for the first couple of years of my apprenticeship that it felt that way because VCs were not making investments, and we got a parade of pitiful, downtrodden people giving their 97th presentation on their companies, and then of course we would poo-poo it and send them on their way. And I guess it felt like an inquisition, but things are changing now, and so now we're more in begging mode. That is, when a good proposition comes along, and they're rare, but when they come along, we're not the only one to know that it's a good proposition. So it's less of an inquisition now and more of a two-way street. We have to sell ourselves to the really good situations, because there are 1,000 venture capitalists in the United States, 1,000 firms.
So how do people prepare to be a good situation? What are you looking for?
Well, I'm only in the 3rd year of my apprenticeship, but what I think we look for are technologies that are absolutely killer, that do something really important and are protectable, and a team that's built 2 or 3 previous companies and knows exactly how to do it. And one other thing, they have to be willing to let us invest in them on reasonable terms. So there's a difference between a good technology and a good company, and there's a difference between a good company and a good investment. And learning those differences is part of what VCs do. So a lot of good companies we can't invest in because they have a different notion of what they're worth than we do. That happens.
Do you use a trusted network of professionals to help you filter through some of those? How does a plan get to you? I mean, you'd be inundated if you just opened the floodgates, I guess.
That's right. Did you all hear that question?
No.
The question had to do with how do we, I guess I'm happy to do this forever actually, talk about venture capital processes rather than networking. And the question was, how do we get leads and how do we handle leads and how do we filter?
You use a trusted network of people that you know. Is that how you do it? I'm just kind of curious how
Yeah.
a plan gets to your desk.
Here's what my partners, who are very experienced, I hooked up with a firm that has experienced people in it because I wanted to learn from them, and here's what they're saying. If I get a business plan from somebody I do not know, I ignore it completely. If it's from someone that I know, then I then have to quickly apply some sort of screen. One of my screens is I'm a Boston area VC, so I'm too old to travel. I mean, getting up here was a real project this morning. So, but some VCs will travel anywhere, but I don't. So if it's not a Boston area company, I try to refer it to somebody else if it looks promising. And then we have a network. Venture capital is a people business, so we have an advisory board, and we have the CEOs and VPs of marketing and engineering of our various. We have 75 portfolio companies, and each of them is can serve as a resource in evaluating business propositions. It breaks my heart not to read a business plan because I've written a business plan and I know how much work goes into it. But if I read every business plan I got, I wouldn't be able to do anything else. Yeah. So there's and our firm is not unique in this. It's a very you strive to be efficient because our job is to make money for our investors. So we have to dig through it all and try to find the companies that are most likely to make a lot of money for our investors.
So you said that one of your criteria was that they had done this 2 or 3 times already. What about people starting out for the first time? Where do they go?
They find somebody who's done it before 2 or 3 times, and they work with them, and then they get their chevrons, and then eventually they then come back having done it 2 or 3 times before. Which leads to a comment on business. Does the University of Maine have a business plan competition? Well, you oughta. But while you're thinking about it, here's 2 things wrong with them. MIT has a business plan competition. The University, Harvard Business School has, well, who cares? They have one too. And
See, we're ahead of the pack. We don't do that wrong stuff.
No, they're very good to do, but here's what's wrong with them. One is, to your point, they convince undergraduates that they are competent to start and run high-tech companies. Because after all, they produced a business plan and they won the contest. And it is extreme. There are counterexamples of Bill Gates, Steve Jobs, but they're counterexamples. And then the other thing wrong is that these business plan competitions, the plans are presented, and then codgers like me sit there and try to evaluate them, and then we choose the winning ones. And we do so all in one day. We have no opportunity to do what's called due diligence, which is what VCs do all the time. We see a plan and then we immediately start calling all the customers and calling all the references and calling the market researchers and calling the journalists. And that's called due diligence, and it's part of the trade. But in a business plan competition, there's no time for that. So the company stands up and says, and we can make chips that are 10 times better than anybody else in half the time. You say, hey, that sounds like a great plan. But there's no opportunity to check whether that's, such factors are actually true. Yes, sir.
Ed Roberts from MIT says that second-time entrepreneurs are 2 to 3 or maybe 4 times what do they say? Second-time entrepreneurs are 2 to 3 times as likely to be unsuccessful the first time. Is that your experience? And if so, then why hire a prior entrepreneur?
Well, I will never contradict anything that Ed Roberts says, but that's not my experience. Now, I'm a successful entrepreneur, but 3Com was the fourth company that I started. So I would be a counterexample to Ed's statistical study. Huh. Does he? No, that's not true in my experience. There are a ton of companies come through that never get started. If they never get started, is that unsuccessful? Or do we only count success after they get funded? When do we start the accounting for that statistical study? I don't know.
I didn't, I went to a lecture.
Yeah.
Probably 10 or 15 years ago, and he reviewed a number of statistics about the venture capital and entrepreneurial community. Among them, the statistic that in his findings, second-time entrepreneurs were less likely to succeed, and the other being that the more founding members of a particular firm, up to 5, the more likely they were to be successful, rather than if a single or 2 people formed the company.
So I don't want to get caught contradicting Ed Roberts, but I don't understand the first one, but I understand the second one, it seems. Teams are much more bankable than sole individuals.
Another question. What is it that makes venture capitalists prone to trends?
The same things that make everyone else prone to trends. This is not particular to VCs, it's particular to human beings. So VCs are, there's safety in numbers. It's a herding thing. So we're out investing other people's money, and our our success depends on whether we're successful and we like company. And for example, right now it is very important to form investment syndicates. So we don't invest in startups unless we go with 1 or 2 or 3 or sometimes 4 other VCs in the same deal, and that's a matter of diversification and accumulating resources, having deep pockets to back the companies. So that leads to lemming-like behavior. Of course, we're all familiar with the failure mode there, is that we can all run off the cliff together, as did famously happen in the year 2000. But VCs are not unique in this lemming-like behavior. It is a problem. So there's a deal I'm working on right now where my partners will only go along. I have to convince my partners to. This is common in a VC firm. You'll have 2 or 5 or 10 partners, and what entrepreneurs often don't understand is they're talking to one of the partners, but that partner has to convince his partnership to make the investment. So I have to bring my partners along with me and convincing them. And one of the pieces of evidence that is convincing is, well, I've got these other 3 VC firms are willing to invest with us. There's comfort in that. Yes?
You talked about a team. What kind of players, what kind of attributes are you looking for next to a team? Are there certain pieces that you want on a team, certain that you don't?
There should be a. Now, these teams often come incomplete, and then it's part of our job to help complete the teams. So, but you don't want to. You can overdo that and underdo it also. So, a great CEO is the key. The least available commodity is an experienced, bankable CEO. But then the team often needs the. Since we're in technology investing, it needs the technologist who has, a grip on what he or she is doing, and then there's often a vice president, sales and marketing-ish person. That's the key part of the team. One of the companies I'm working on right now, there's the team. There's 3, a sales guy and 2 engineers, and they know they need a CEO. So one of the things they're looking at is they're saying, "Can you help us find a CEO?" And that's one of the things that we do. The team has been raising money for 9 months, and one of the reasons is they don't have that CEO. So it's they have to get over that hump, and they haven't yet. And we haven't made the investment yet either. We're still looking at it. So aside on this inquisition point that you raised, VCs take a long time to evaluate making an investment or not, doing their due diligence, and it can stretch out to a year. It's not a week. I got a call from a guy yesterday. He said his company's running out of money and next week, and would I be, bridge him for $50,000? And no. There's no. That's not the kind of thing that VCs do. He had to go find sort of a swashbuckling angel investor to do that sort of thing. Somebody who's not investing other people's money.
And what kind of stage companies are you in? What life cycle?
That varies from different VC firms, shading over into what's called private equity firms, have different targets. Polaris, the firm I'm with, is highly diversified in technology and stage. So we do seed. Maybe we should delve into this, but the seed rounds, A, B, C's, all the way to just before going public rounds. So we call it life cycle investing. So we can make very small investments, but we intend and reserve money to make investments at subsequent rounds in the evolution of the company. Some firms do only seeds, some do only A's, some do only B's, some do only mezzanine, which is just before going public. Now you have to do, there are loge, what I call loge rounds. They follow the mezzanine in there because the companies can't go public right now, or very few of them can. So there's additional rounds getting done that are all pre-public.
Can you say something about your first three companies? Before 3Com?
My first three?
Yeah.
Oh. Yes, that was a long time ago. Let's see. I started a company called Management Systems Consulting, and we did linear programming for professors. And then I went to graduate school. I spent most of my time designing the stationery and getting the P.O. box on State Street. And then we got a contract to do some linear programming, and then I went to graduate school and abandoned the company. But the guy, our only employee, there were 3 partners and an employee, he took the company and he made it into a company called Management Decision Systems, which 25 years later he sold to Oracle for $100 million. But I didn't own any of it at the time. So, and then was...
It indicates a good touch.
No, it was this guy we recruited. Yes.
You hired
We were smart enough to hire the guy, yeah. And we were appropriately compensated for that. And then the next company was called Data Concepts Design. And that was also a consulting company whose purpose was to document the usage pattern of a time-sharing system so that its customers could use it. This was an old PDP-10 time-sharing system service out of Boston called Computility, and they gave us a contract to write manuals for them. That lasted 2 or 3 years. And then I started joined a company called Professional Data Service.
Did that one then just close down, or did it go on?
We all finished and wandered off. Yep. And then Professional Data Services was a legal software for law offices, and we never finished the software before the CEO got married and moved away. And then there was a gap, and that was in the early 70s, late 60s, early 70s, and then 3Com was founded in 79.
And how many people were involved in family?
It depends how you count. See, I was the only employee for 6 months, and then there was Greg, and then there was Ron and Howard, and so by the time we raised venture capital, there were 12 of us. And then a few years later, there were 12,000 of us, all founders. There's a tip for you, by the way. We run into all these companies where these guys have cards that say, Tom Smith, founder, CEO and founder. Can you imagine? They walk around their company saying, I'm a founder and you're not. And this is not good team building behavior. So it's my practice to call all the employees of a company founders and be sure they have stock. So there were 12,000 founders at 3Com at one time. The number's quite a bit lower now. 3Com hit $5 billion in revenue, and I think they're about $600 million now. I retired in 1990, so I have nothing to do with it. Some more questions? So, yes?
Venture capital rounds can be
Well, we're always trying to invent new ways to be, huh? Well, the due diligence process is really long, and in fact, I've noticed in several cases, now that I'm getting experience, startup teams can get tired. And as they get tired, they become less good at impressing investors. So one of the things we do is we string them along forever and run them into the ground. That's a bad thing. Sometimes VCs will, one of the things VCs do is they make important judgments about people. And sometimes a VC firm can be wrong about that and misjudge, say, the founding CEO and through investment and the control that comes with the investment, force a change of CEOs, and sometimes they're wrong. Now, I would never make this mistake, but VCs can be wrong when they make personnel decisions like that, and they can kill companies. Giving companies too much money is a way of hurting a company. I know it sounds silly, but if you give a company, if there's too much money around in venture capital, the company never develops a cost control, profit-oriented culture, and it's very hard to change cultures of companies. And so once you get into the big spending mentality, it's very hard to eventually make a profit, and that means you die eventually. Too much money means that if the VCs have too much money, they not only fund your company, but they'll fund 9 others that do exactly the same thing. And that's not good for you either, because around the time you're coming to market, the other 9 are coming to market, and that can be cutthroat. And there's nothing worse than a company that's going out of business, to have a competitor that's going out of business, because they screw you up really badly. They give everything away for free, they disparage you, so you don't want to have 9 of them, assuming you're successful, you don't want to have 9 competitors going out of business around you. It's bad for business. So those are 3 things. That's right. Well, that's very complicated, but you're right. Venture capitalists are in the business of making returns on their investments. Everything is negotiable. There are hardly any. Let's say there are no rules of thumb. Everything is negotiable. And some people are better at negotiating than others. Some people are more desperate than others. Some people are more confident of themselves. Our company, 3Com, when I was starting 3Com, we were at one time presented with a term sheet from, I'll just name one of the firms, Venture Rockefeller, which has to be one of the classiest VC firms around, and we said no. We had a little meeting, and we all decided that they were offering such a low price for our stock that we'd prefer to go back and work for Xerox than put up with that. And they came crawling back later, and we got a better price from them. But everything's negotiable. Another thing that often happens is to attract investment capital, entrepreneurs will often lay out a plan. And then the evaluation of their company will, to some extent, be based on that plan. And then for some reason or other, the plan does not come true. And that can really be hard well, it's hard on everybody, but the management who promised this plan in return for the investment usually takes it in the shorts at that point. Because they run out of money, and then they become desperate, and then the power in the negotiation swings away from them. Yeah.
You were talking about distributing stock to all the employees. One of the things that I see in a lot of startups is that people get into all kinds of tussles over ownership and how to divide up stock and how to do that. I mean, what kind of model, what was your model with Recom or what do you think is a good model for a startup company distributing stock and how does it do it?
That is, did you all hear the question had to do with how equity is divvied up among the employees of a company? Mm-hmm. I had a dinner at the Bella Vista restaurant on Skyline above Silicon Valley in 1979. I invited the 3 guys that I wanted to start 3Com with. And in the middle of dinner, I took out the proverbial Silicon Valley napkin and took my pen and I wrote down, well, I'll have 51%. And Greg, you'll have 18%, and Ron, you'll have, since you're like Greg, you'll have 18%. And I divvied the whole 100% up. And would you like to know the science of that? Well, 51 is more than half. And since I fancied myself to be the prime mover in this situation, I figured I should have 51, as if. And then I divvied it up among these junior guys, less senior guys who had worked with me at Xerox. Two of them just left. And they didn't join the company. One of them signed up on the spot for his cut. I had to lend him the money to buy the founder's stock, and then he paid me back $300 a month for 10 months, and that $3,000 became $5 million, and then he spent it all, and then he went to Microsoft and he made himself rich again, but he's busy spending it again right now. But I guess my point is, experienced VCs each have their own templates about what the proper division is. For example, if you have a startup company like the one I just mentioned that doesn't have a CEO, but it's got a pretty good team and a damn good idea and some technology in hand, we have to, when we make the investment, we try to plan for there to be stock options, a pool of stock options to be granted to the employees as they're recruited. And we have to look ahead because that dilutes ownership as you give those out. So we make a plan for how much equity is going to who. And just for round numbers, this highly experienced CEO that we would hope to add to that team that I was talking about before would get 6 or 7% of the company. It's negotiable, of course. So the person might try to hold out for 10 or might settle for 5, but in our goal we wrote down 6 or 7%. And the head of sales would be 1.5%, and so there are numbers like that, but they're just a starting point. It's really negotiable. It depends how experienced you are.
You started at 51%, and then
I have a certificate on my wall, 3Com Corporation Certificate Number 1, 51,000 shares.
So you started with 100,000 shares.
Yes, well, but two of the guys walked out, so my 51%. My 51,000 shares was really 86% of the company or something because the other two guys didn't show up, so my percentage went way up. I had some notion that I wanted to control the company, and I read somewhere that 51% controls, but control is a really strange thing. You have to give up control to gather resources. And that's one of the pathologies of starting a new company is unresolved tussles about control. So a company can just fritter itself away arguing about control or adopt some model and go forward.
So how did you started, say, with 86%. Historically, then what happened?
I sold my first venture capital round. I sold a third of the company for $1.1 million, which is a really low price certainly in the year 2000, it was a very low price. And then we did 2 more venture capital rounds. We raised $2 million the next year, and then $4 million the year after that. And then we went public and raised $11 million, and then we did a secondary for $25 million after that.
So how did your percentages fare?
It kept going down. I don't remember the numbers.
So when you went public, what percent did you own roughly?
What's the number? I don't remember. Less than a quarter. 10% maybe. I don't remember actually. Some more questions? Yes.
I'm fascinated by the idea that said that for startups, a lot of times VCs will go in as a syndicate to kind of diversify and reduce risk. But it seems at that stage that it's really the startup is all over the place and they need a laser approach to be successful.
Right.
The funding sources are coming from disparate groups with perhaps different management strategies, different, I want to say egos, and many different focuses.
Oh, you've done this before.
I'm just curious, how does that work? Or does it all come to the lead investor saying, you know what, look, we're just going to be such minor investors, this VC group, and everything else is going to have, the most influence on the company. Or how does that work?
That's the problem that gets resolved during the formation of the syndicate. That's what you're doing when you're creating the syndicate, is you're looking for simpatico investors who you know, who can be helpful. So this company that I'm trying to start now, or invest in now, I'm trying to get a Silicon Valley firm in. I have a short list of 3 of them who I know, and guys who know how to do this kind of company, and that we already know each other, so we're not likely to have a fight. But that is something that can go wrong. The VCs can disagree on strategy, and that's...
You develop the process and control, but you write it out.
Yes,
Or
in the...
is it a gentleman's agreement saying,
No.
we just know each other, we're buddies, we know how each other works? Or is it...
The word gentleman does not occur in our lexicon. It's not. There's a contract that says what who will be on the board, and usually some number are from the investors, some number are from the company, and some number are mutually agreed upon independent directors. And this is all structured to really deal with conflicts of the kind that you're worrying about right there. So that's all written into contract. And so you might say that, for example, Polaris shall have the right to appoint 2 directors. Initially, those will be Bob and Tom. And Morgenthaler Ventures will have the right to appoint 1 director, who initially will be Bob Pavey. So that, but it's in the negotiation of that syndicate that problems with control are anticipated. There's also voting rights agreements that say if you want to raise more money, who has to approve that? Certain percentage, like 3/4 of the preferred stock must be in favor.
Is this decided among the syndicate itself, or is the company left in the dark while this is going on in negotiations?
No. No, well, not in our case. So there's the prime mover at the company, let's say the CEO, the founding CEO of the company. He's out, in this case, raising money he doesn't have any money yet, and he's getting tired. It's really upsetting him, and I don't blame him. And he doesn't have any term sheets from anybody. So I'm trying to get some term sheets. I'm trying to put together a term sheet if I can attract the right syndicate. So I'm talking to him about the kinds of terms that we would be thinking about, and he's giving it. For example, he just gave me some feedback. He said he and his 2 founders, when the company reaches 50 million in sales and is therefore worth 100 million, they each want to have $5 million. That's input. It goes into the terms. And he thinks we should recruit a CEO in the next year. We agree with him. And those are things that we're assembling to put into a term sheet, which he will then compare with term sheets he might get from other syndicates, if he's lucky. Yes?
You mentioned a bit, talked a bit about a fairly difficult and somewhat lengthy process, particularly in technology, to attract, for a startup, to attract the attention of venture capitalists. How, from the venture capitalist side, how do you protect against failing on, let's say, the next best thing since internet?
Well, that's what we live in fear of. In fact, I've developed a new, over the last year, we turn down lots of entrepreneurs who would like us to invest in their companies, and I hate doing that, but I've thought of a good way. When I kiss them off, to be harsh, I say, now it's up to you to prove us wrong. Because we have to make judgments. We might be wrong. We may be missing. And by the way, I have a long list of the VCs who didn't invest in 3Com. And every time I see them, I remind them. Oh, yeah, I remember you. You didn't like my plan. Incidentally, we didn't use my plan. We changed my plan right after getting the money, but he doesn't know that.
But along with judgments on proposals that come to you, you must be making some judgments in terms of underlying technologies, and specifically with respect to networking technologies, where, even though you're interested in all 7, what is happening with each? What's the differential excitement that you feel right now?
You know, the hour's almost over. Well, I have a pretty exhaustive list of the 7, but in deference to your question, there are new frequencies opening up above 50 gigahertz. Our firm has noticed this. So we are looking for, I know it, if you don't know about spectrum, and I barely know about spectrum, it's hard to understand, but there's this huge amount of bandwidth being opened up. It's being opened up both by the FCC, but it's also being opened up by technology in that the chips are now getting fast enough they can operate at 50 gigahertz and above. So if you think 802.11 is cool, 802.11 is cool, but it's we think a huge new frontier opening up of between 50 and 100 gigahertz for various wireless applications. Very high speed, huge amounts of bandwidth, great signal characteristics, etc. So that's one area where we think that there's a that cellular telephone like this and 802.11 internet access are converging rapidly. So dual mode phones are coming out now, where the dual in that case means cellular 802.11. So we're starting to invest in companies that anticipate the convergence of what we think of as the 802.11 wireless LAN and the cellular telephone. We are going way down in networking, not 10 gigabit Ethernets, but at the very low end, RFIDs. We've invested in 4 companies that are participating in one way or another in the radio frequency identification business. For those of you, did you just have a speaker on RFIDs here? Because it's a very hot thing. It's a bit of a bubble, actually, like .coms and stuff. But anyway, in the VC community, RFIDs are now hot. If you know about barcodes on all those consumer products, the trouble with barcodes is you have to take the object and you have to put it over that little glass laser thing that reads it. So the next generation of barcodes is RFIDs, where it's radio. It's read by radio rather than laser. So imagine going shopping and putting all your items in a shopping cart and just walking out the front door, and they hand you your bill, because it's automatically just read everything in the shopping cart. Or if you've ever driven through the fast lane, Maine has a fast lane. It's incompatible with the one in Massachusetts, I might add. That's right, the Doppler. The Doppler shift, it was shifting it out of the receivable frequency bands. I see. But those are RFIDs of a kind. Those are high-end RFIDs, intelligent ones. The big question on that market is, when is it going to happen? Walmart has said that very shortly all of their suppliers have to deliver products with RFIDs on them. And the United States Department of Defense their logistical command wants to take everything in the military and put RFIDs on it. For that to happen, RFID tags have to cost 2 cents or 5 cents. Right now they're $1 or $2. So the first things that'll get tagged will be pallets and maybe boxes and maybe trucks. But eventually RFIDs will be made in the billions, and they will be on individual. The vision is they will be on individual items. And in venture capital, timing is everything. So we have to be careful and often make mistakes about investing in a company that's either ahead of its time, in which case it spends all of its money and goes out of business, or it's too late, in which case its competitors get all the business and they run out of money and go out of business. So you have to get that just right. And that's the big question in RFIDs. But that's a hot area. We're in four companies there. Yes, sir.
Part of the research has graph depicting that by the year 2010, only 5% of network traffic will be computed. They're looking heavily to growth in embedded systems using some of the new lower-end standards. I think we're referring to like Zigbee and so forth. Can you tell us what you think of that area?
Yes. There are approximately 8 billion microprocessors shipped every year now. That's more than one for each human being on Earth every year, over and over again. But only 1 or 2% of them are networked. This is my lead-in to why we made this investment. So we've invested in a company called Ember, and 20 of them now, companies who are focused on networking that other 98% of the microprocessors. And those are all embedded microprocessors, very low end. So the networking has to be very low end, generally wireless. And it's a huge space with many places that you can play. It fades into RFIDs. At the low end of embedded networking is RFIDs. You can network the readers, you can network the tags, or you can go up into things that don't look like RFIDs anymore. One of my favorite examples is we're trying to win a customer who hangs a sensor on a power line and measures the angle that it's drooping. And as they run more electricity through the power line, it gets warmer and stretches, and it droops more. And that node needs to get its information and send it back, but it's very expensive to do that. But if you put one in every power line, then these nodes can talk to each other and relay all the traffic back up to mission control. So that's a kind of embedded processor networking. Lighting controls. Very soon, all of these. It's a really annoying light. Lighting controls will be embedded networked. That's a big customer, potential customer now for Ember. And the list is endless of embedded networking applications. Microwave ovens often say 12. 12. Why is that? Because they don't know what time it is, but if they were on a network, they could find out what time it was, and so our goal is to get all those flashing 12s to go away. So that would be embedded networking, and there's 20 companies in that area, and I believe that those 20, even though they all believe they're in the same space, will probably never compete with each other because the space is so huge and very specialized. Yeah, Ember, for example, is now monitoring all the fish that Legal Seafood takes from the dock to the restaurant to be sure that it never gets warm. So there's a little temperature sensor. When the truck pulls up to the restaurant, the little reader interrogates each of the pallets and is able to tell whether that pallet has ever fallen above a certain temperature, in which case the fish are rejected. And the same is true of pharmaceuticals. Merck currently is shipping drugs that they need to keep cool. This is called cold chain management. It's an application. It has to do with the fact that a lot of that which gets shipped around is perishable and much of it is lost. And they want to be able to tell if it's rotten before they take it off the truck, because they have a hell of a time getting the Teamsters to put it back on the truck. So they want to read it from the truck as the truck is pulling up to the dock, and not when it's in the store. More questions?
Have the private equity markets made any adjustments in the terms or the conditions or the way that they finance VCs?
Finance VCs?
Yeah.
Yes, there's our firm has not been affected yet, but many because we've kept our nose clean. But there is funds have been getting smaller recently, if I'm responding to the right question, and so you all understand that VCs have to get their money from somewhere. So when I say VC, I'm talking about firms that invest other people's money. Angels are people who invest their own money. VCs must therefore be devils, I guess. And so we have to raise money, which is what you're asking about, I think. We have to raise money from people we call our limited partners, who are generally pension funds and mostly pension funds, but also wealthy individuals and corporate venture capital and governments and so on. And so we have terms and conditions with them. Generally, they pay us a fee to invest the money, and then we split the profits with them. We generally get, and that's the kinds of terms you're talking about, is how big the fee is, 1% of the money committed, or 2% of the money committed every year, or 3%, or 0.5% in that range, and they're going down. And then there's the share of the profits. After you pay them back the money they've invested, how do you split the profits? And VCs get 25% or 20% of the profits, if any. Something like that. And those terms have been going down, and the size of the funds have been going down also.
Is that because of what happened between 95 and 2000?
Yeah, absolutely. Yeah, there were horrible excesses, lemming-like behavior. We went from 300 VC firms to 1,000 VC firms peaking in around the year 2000. Of course, VC firms don't go out of business. They sort of piddle away over a 5 to 10 year period. So I estimate about 700 of those 1,000 are piddling away over a 5 to 10 year period because they won't be able to raise new money, because they're brand new firms with no track record. They raised one fund, they lost it all, and they're going to go back to the LPs and say, let's do a new fund, and the LPs are going to say no. Now this is good for companies like, now I chose Polaris after it dodged the bullet, so I'm not responsible, but Polaris has a highly diversified investment strategy, so we didn't invest heavily, my partners previously did not invest heavily in dot-coms or telecom companies, which are the ones that really crashed and burned. So when we go out to raise money, the LPs say yes. Thank goodness. So we have we manage about $2 billion, and our last fund was $900 million, of which we've just started investing. And we start about one company a month. There are 16 of us who make investments, and we start about one company a month. So that's one per year, say, per person, which means you get to see a lot of companies and say no, which is sad, before you say yes.
Polaris invest in security and data rights management?
Yes, we have one of our partners really likes security companies and authentication, and goes on. We also have an interest in spam. We're interested in suppressing spam, but I happen to think we're making big mistakes there. Filtering is not the solution to spam, and we're investing in. Do you filter spam?
Yeah.
Well, let's talk later. The trouble with relying on filtering, which is what they do now generally, is A, it doesn't work, and B, is it has a third party reading all your mail, which you don't want. So there have to be other solutions. Anyway, we have an investment in a filtering company, and this is an unpleasant speech I give them every time they show up.
Unless the filtering is at the edge.
The closer it is to me and it's more specific to me, the better it gets. Yeah. For example, if I do my own filtering, then a third party is not reading my mail and my objection goes away.
Well,
More.
thanks for one more question or so.
Yes.
About a lot of communication networking. How do you feel about services that are based on those adaptive and ubiquitous technologies such as location-based solutions? Do you see any other trends moving in the near future?
Yes. Businesses that involve latitudes and longitudes are emergent, because the number of devices, the GPS, proliferation of GPS is creating all sorts of, am I answering your question? Creating all sorts of opportunities for companies that generate or process or do something with latitudes and longitudes. There's this great company which we decided not to invest in because it was going to be too small, we figured, and they're going to prove us wrong. They read documents and they deduce from having read the document what latitude and longitude it's about. And the first customer for this, of course, was the National Security Agency, who wants to know where Osama bin Laden is, so they read lots of documents to try to figure out where the son of a bitch is. So we really like that company because it deals with latitudes and longitudes. So that's a kind of investment theme. Things involving geographical information are, the trend is in their favor because of the increasing opportunities for applications in that area. We're also we're looking to make investments in the area of blogs, but we're waiting to see how to make money there. We're really excited about the interpersonal dynamics of blogs and so on, but there's no business model yet. So if you have a business model for making money with blogs, we'd love to talk to you because we're pretty confident. I was a little slow on spreadsheets, and I was about 2 or 3 years behind on the web in general, and this blog thing feels just like that.
Do you want to share some final thoughts with us?
Well, I'm glad things went the way they did. I was prepared to talk about a completely different, no, not a completely different subject. Anyway, I guess I'd want to close by saying venture capitalists have a bad rap. A lot of them deserve it. I did say 700 of the 1,000 are going out of business, and good riddance. But venture capital is a very high calling. It's a very specialized. You imagine all the stuff that has to work for there to be a niche for people to be venture capitalists. I mean, there have to be limited partners, for example, and there have to be entrepreneurs, and there have to be lawyers, there have to be accountants, there have to be public markets. And in my analysis, it's an essential part of, we brag about the innovation, the success of the innovation culture in America, and one of the essential technologies, if you will, social technologies that makes that work is the existence of venture capitalists, and I'm proud to be one. Thanks.